Kind of, yeah. Yeah, that's how I kind of understand it. Any other questions? Good question. Okay, so there's earnings per share. We want a bigger earnings per share because it measures, kind of measures the percent of earnings we get in the company. Our next one is working capital and then current ratio.
Is this what the layout for the exam is going to be like?
Do I know the layout?
Is this what's like?
No. Well, I mean, maybe similar. But no, I made this, so it's not going to look similar, if that's what you're asking. I mean, the layout should be, the question should be similar. But the layout of like how I put the balance sheet, no. Like in that Excel file or where you guys wrote the income statement, no, that won't be the same. So we've got our working capital. Which is our current assets minus our current liabilities. And we've got our current ratio, which is current assets divided by current liabilities. How much is our current assets? Which financial statement do we get this information from? From the balance sheet, yep. So our balance sheet, we've got current assets of a total 77. There's our current assets. And then our current liabilities is 90. So that gives us negative 13. Is that a good working capital or a bad one?
Bad.
It's a bad one because we want a positive working capital. We want more current assets than current liabilities. Our current ratio, pretty similar, 77 divided by 90. That equals, anyone have it? .85 or 85%. Is that a good current ratio or a bad one? It's still bad, yeah. We want one that's bigger than 100% or bigger than 1. This is saying if we needed to pay all our current liabilities right now, using our current assets, we could only pay off 85% of our liability, or 85% of our current liabilities, which is not good because you want to be able to pay off all your liabilities if you need to. And the last one was debt to assets ratio. Did you guys learn this one? Debt to assets? Yeah? Okay. I can't remember. Which is total liabilities over total assets. So our total liabilities are 180, and our total assets are 219,500. gives us about 82%.
Where did you get those numbers from?
So our total liability, yeah, good question. Our total liabilities are the current liabilities plus our long-term liabilities.
Okay.
Our total assets is all of our assets. Any questions with this before we move on?
Now is that a good percentage that we can see, or?
Yeah, good question. So 82% means in our company we have 82% debt and about 18% equity. Or you can think of it from all of our assets that we own, 82% of them were purchased from debt. We took out a loan or we bought some assets without paying them yet. 82% of our assets are from debt. 18% of our assets are from equity. People invested money in us. And I got that number from just taking 100% minus 82, it's 18%. But the debt to asset ratio is 82%. Cool with that? So we'll move on to making some journal entries. I'm sure everyone really wanted to do that. So we'll start with just regular journal entries that we make throughout the year. And maybe I should point out, these journal entries, each section of this review packet, the numbers aren't connected. Unlike the TA review tomorrow where you do one thing and it's going to follow you the rest of the review. None of the numbers are connected with each other. So our first journal entry, we purchased a building for $50,000 cash. And maybe I should put kind of a cheat sheet. Or you guys, what was the other one? Dean or something? Or dealer? I'm not really sure how to use this, but you can use that too. Okay, so we purchased a building for $50,000. What's my debit gonna be? Building. I'm gonna debit the building for $50,000. I'm increasing this asset. And what else? What's my credit?
Cash.
Cash, okay. Perfect. Decreasing this asset. Next, we issued some common stock for $60,000. What's my journal entry? What's my debit going to be?
Cash.
Cash. We're receiving cash. Investors are giving us $60,000. So we're going to increase cash. And credit what?
Common stock.
Common stock. Yeah. Which is an equity account. For 60. There we go. Any Any questions on this so far? Next, we purchase some supplies on account. What's my debit? Supplies, yep. What kind of account is supplies? Asset, liability, or equity? We're increasing this asset, and then credit what? Accounts payable. Which is a liability. We're increasing a liability for 2,000. There you go. If we purchased with cash, we would have credited cash. We borrowed $3,500 from the bank at 5%. What's my debit? Cash. Cash. Yep, we're taking out money. We're getting money from the bank. We're going to increase cash, increase the asset, and then credit. Note payable. Yep. We're setting up a liability for $3,500. Increase that liability.
So can you just ignore the 5% then?
Good question. When we take out the loan today, 5% doesn't matter. When do we care about the 5%?
Like in the year?
Over time.
Oh, you're adjusting to entries.
Yep, and our adjusting entries are, over time. Yep. But usually during our adjusting entries. Next, we received $4,000 for services we have not provided. What's my debit? Cash, that's an easy one. We're increasing cash. Someone is giving us cash for 4,000. What's my credit?
Unearned.
Good, yep, unearned service revenue. What kind of account is unearned service revenue? Liability. Why is it liable, or what are we liable for?
We own service.
We owe services, yep. Even though it says unearned service revenue, it's not a revenue, it's a liability. Where are we? Received $20,200 for services provided, not related to, before we go there, this journal entry, if we're in the cash basis of accounting, what would happen here?
We just consider it revenue.
We would consider it revenue, yep, for cash basis, which we don't do. Whenever we receive cash is when we record revenue. But in accrual accounting, we only record revenue when we earn the revenue. Questions on that? We'll talk a little bit more about that, maybe. So we received $20,000 for services we provided, not related to this previous one. What's the journal entry? Cash, yep, for 22. And then what?
Service revenue?
Yep, service revenue. So again, why are we recording revenue here but not here? The services were performed. The performance obligation, as we call it in accounting, was fulfilled here. It was not fulfilled here. So there's no revenue here, but we can record revenue here. What if we performed services, but we didn't receive cash? What would the journal entry be?
Accounts receivable.
This would be accounts receivable, because someone owes us money. Any questions so far for those? Few more. We paid rent for for a year. What am I going to debit?
Prepaid rent.
Prepaid rent expense, yeah. What kind of account is prepaid rent expense?
Asset.
It's an asset, yep. It's not an expense. It's an asset. For $6,000. What's my credit going to be?
Cash.
Cash. Spending cash? If this was cash basis of accounting, how would this be different? It would be rent expense, yes. So in cash basis of accounting, whenever we spend money, we automatically consider it an expense. Whenever we receive money, we automatically think of it as a revenue. In accrual basis of accounting, which is what we do, we don't care when we spend cash or when we receive cash. Whenever the performance obligation has been satisfied, determines when revenue or expense is recorded. So in this case, has the performance obligation been satisfied?
No.
Not yet, no. Once we live at the house or live at the apartment, that's when the performance obligation will be satisfied, or start to be satisfied. We paid the full amount due for supplies in question number 3. So we purchased supplies before on account, and now we're paying it off. What's going to be debited?
Accounts
That's
payable.
good.
Accounts payable? What was the dollar amount? Was it 2,000? Credit what?
Cash.
Here we go. Hired a new employee who worked 40 hours a week for $20.
Nothing.
Nothing, yeah. There's no transaction occurring, there's no transfer of assets, or no transfer of liabilities or equity. So no transaction. We paid the employees wages of $1,500 in cash. What's the journal entry? What's it? Yep, salaries and wages expense as a debit. And the credit is, what if we didn't pay them cash? What if we're going to pay them in a few
Account
days?
payable,
Not accounts payable,
wages and salaries.
wages and salaries payable, yep. And then the last one, we've got a $2,000 cash dividend. We declared a cash dividend, but we haven't paid it yet. So what's the journal entry? What's my debit? Dividend, yep. If you put dividend expense, that's wrong. And I'm guessing they're going to mark it wrong because accountants don't like that.
Okay.
So it's just dividend. And then what's my credit?
Cash?
If we paid cash, it would be cash, but
Payable?
no, not accounts payable, not accounts receivable. It's a liability because we owe the shareholders money.
Is it bonds?
No, not yet.
Mortgage
Dividend payable.
Oh,
Maybe you guys didn't learn that one.
no, I never heard that.
Oh, okay. So then don't pay attention to that. Any questions on any of those journal entries?
For the wages, expense, payable, is it like, if they already work, pay them, that's expense, right? But if they haven't worked yet, we pay them, that's payable. Like, what is it mean?
Say that again? I'm sorry, I didn't.
Like, when is wages, payable, and expense, like, when, like, on the level?
When do you do wage expense?
Yeah.
Good question, yeah. So he's wondering, when do we recognize a wage expense? When do we recognize a wages payable? And when do we recognize cash? So when do we recognize a wage expense? Anybody know? According to accrual accounting.
They work for us?
Once they work for us, yep, which is the performance obligation. Once they work for us, we can recognize a wage expense. And then for a wages payable, if we haven't paid them yet, that's a wages payable, or if we pay them cash.
So if they work for us for a month, but we haven't paid them, would that go, would we debit expense and then credit payable? And then when we pay them, we just credit the payable and then debit the payable, credit the cash?
Yep, you got it. Any other questions? So we're moving to inventory, which is what we learned this week. So purchasing and selling inventory. So I did change that thing, highlighted up there. So we're purchasing inventory with two terms 210 net 30 and $200 in shipping costs. What does 210 net 30 mean?
They get a 3% discount, they pay within 10 days.
Yep. So we get a 2%, or they get a 2% discount if they pay in 10 days. What else?
Or full payment within 30 days.
Yep, they have to pay the full amount within 30 days. And these numbers can change. It could be like 310 net 30. And we've also got this thing called FOB shipping point. And FOB destination. When does ownership transfer for FOB shipping? Let me ask you this. If we're buying inventory, do we own the inventory when it's being shipped, or do the sellers own the inventory?
Sellers. Like when it's being shipped? Yeah.
We do. We actually own it. So this is kind of how I think of it. So we've got the shipping point, and then they're shipping it to the destination. I think of it like Amazon. I order it from Amazon, then they send it to my house, which is the destination. So FOB shipping point tells you when the transfer of assets occurs. FOB shipping point, the transfer occurs at the shipping point. So when it's on the road, does Amazon own it or do we own it?
The seller. The seller?
We own it.
Yeah.
This guy is buying inventory. We're buying from Amazon. So the ownership transfers here. We own the goods when they're on the road for shipping points. For destination, the transfer occurs once it reaches my doorstep. So Amazon owns it. So if we're buying inventory and there's shipping costs, are we going to pay for FOB shipping or FOB destination? Do we have to pay for shipping for which one? Shipping points, yeah. Because shipping points occurs here. We own the goods while they're being shipped, so we have to pay for shipping. Hopefully that makes sense. FOB shipping point is really the only one you got to worry about. So we purchased some inventory, shipping cost $200. We bought with FOB shipping. What's the journal entry? I'm going to debit what? Inventory. We're buying inventory. And we'll split this up into two journal entries. For how much? 3,000? What am I going to credit? Accounts payable. Yep. Because we didn't pay cash. And you can assume that because we've got terms, 210 net 30, which means we haven't paid it yet. There's my first journal entry. What's my second entry? No. Go guess, Doc. Yeah.
If we're buying it, isn't it just part of inventory? If we're paying for the shipping?
Yep. Exactly. So we're going to debit inventory again. For the $200. Any costs that we pay to get the inventory, we include in the price of inventory. And then credit, let's just assume we're paying cash, so we'll credit cash for 200 to make it easy. Question? Yeah.
Would it be incorrect just to combine with the initial entry?
No, you can do that too. So you can debit inventory for 200, credit accounts payable and cash. Yeah, you can do that. Any other questions? So that's the first box on September 1st. Second box, we've got the next day we returned a fourth of it. What's my debit going to be?
Accounts payable.
Accounts payable. For how much? $750. I assume. How'd you get that?
That's 1/4 of 3,000.
Yep, 1/4 of 3,000, $750. And then what's my credit going to be? Inventory, yeah. So maybe a good, I don't know what you would say. Whenever we're returning it's pretty much just flipping this previous journal entry. It's going to be pretty much the same for selling inventory. Whenever there's a return, it's just flipping our original journal entry. The numbers are different, obviously, but. And then on September 9th, we paid for the inventory in total. So do we get the discount or no?
Yeah.
We do. Because we bought it on September 1st. And on September 9th, we're paying it. So we're paying within 10 days, so we get a 2% discount. What's going to be my debit? Well, here. Correct, accounts payable. How much in accounts payable do I owe right now?
2,250.
2,250, and we can figure that out by making a T account. Accounts payable, we started with 3,000 as a credit on September 1st. We returned a fourth of it, so we debited accounts payable for 750 on the 2nd. So, as of September 9th, we've got 2,250. So on September 9th, we're going to pay off that full account payable, 2,250. So on 9/9, we paid, or I'm sorry, we decreased accounts payable by 2,250. So we're left with a zero balance. How much cash did we pay?
2,405.
2,205. Yep. So are we debiting or crediting cash?
Credit.
We're spending cash for $2,205. And we figure that out by taking the 2% discount. So we owe $2,250, but we got a 2% discount, which was $45, it looks like. So you take 45 off of how much we owe,